welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And today on the show, we're talking about how much money do you need to be happy? And we have some data for you about the exact dollar amount you need in order to be happy here in New Zealand. Now, look, you might think, why are we talking about this on a show that's all about property? And I think one of the things that has really surprised me is that so many of you listening to the show say, I finally found my why. And it might be about you're investing in property for your retirement or to build a passive income, or you just want to get rich or something else. You want to send your kids to private school, whatever it happens to be. But I think investors need something to aim for. And I know certainly 65% of the people we survey, Andrew, typically say they're either looking for some sort of better retirement or some sort of passive income later on in their life so they can retire early. So I think people need to know, well, what is that dollar amount that I potentially could be aiming for? And then they can formulate that plan to figure out how to get there. In some instances, it might be through property. It might be through a range of assets.
So what's the ideal income in New Zealand dollars? And this was in a newspaper article recently. So it tweaked my interest. And so
Tweaked your interest?
It tweaks your interest,
No,
doesn't it?
Piques your interest,
It piqued my interest and tweaked it. And so anyway, I saw that, okay, right, it's peaked. I read this with interest because I wanted to know what that magic number was. And it's quite a specific number, $178,844. Now, I'm imagining a couple of guys in lab coats looking like Ed, standing there with a guy sitting on a chair looking like me, and they're giving him $1, the 843. No, not that happy, not much of a smile. Then 844, and then he grins, and then they stop. That's the limit.
The amazing thing, and anybody who's watching the video of this will be able to see it, is that you're making it like you're giving me notes, but in dollar amounts, that's a coin. You should have a coin slot.
Oh yeah. Anyway, so where did this information come from? So there's a university in the US called Purdue. Purdue. Yeah, that's what I said. University, and they did a study to look at the income satiation. That was a word I learnt today, which basically means happiness. And so there's another website called Expensify, who's a money-based website, and they actually adjusted this for different areas in the world, and they looked at the cost of living and currency, and New Zealand's magic number is that $178,844.
And the key thing there, income satiation, is about when an extra dollar makes you no more happier. So I pay you an extra dollar, Andrew, 178,843, give you the extra dollar, boom, that's your peak happiness.
And they say that money can't buy happiness.
And the question is, does everybody agree with this? Because if you read some of the papers, Shamabeel Jacob, who is quite a famous economist here in New Zealand, certainly gets a lot of the headlines, typically comes out and says that income starts to level off, or happiness from extra income starts to level off at 80K. And you might think, well, is that at odds with this study from the University in Indiana? I would say no, because there's always this thing, and you've got to be careful when you read the papers actually. They'll say, well, happiness starts to slow down at $80,000. But that still means that the extra dollar doesn't make you as happy as the previous dollar.
Still makes you happy,
yes,
just not as happy.
Yeah, so
you get 97 cents worth of happiness.
So going from 79K to 80K might have made you, I don't know, an extra 20% happier, and then every dollar after that only makes you 5% happier, or something along those lines. So peak happiness is at that 179K level. Add an extra couple of grand, might make you less happy, more money, more problems.
And actually, I just wonder whether or not happiness is the right word for this. And I wonder whether or not it's just being unhappy or worried about not having money. Because, I think it is true. Money can't buy you happiness, but not having money can be really, really terrible as well. And so I did a quick Google before and saw that there was a study in the US a couple of years ago, and they asked the people who were taking the survey what kept them up at night, and 57% of Americans were worried about money. And so, if you're unhappy because you don't have enough money, I can understand that extra dollar makes quite a significant difference.
And I guess the question that comes back to this show is, well, how does that first of all compare to the pension? Because a lot of people will be thinking, okay, how do I get my 179K in retirement? Can I get it from retirement and super?
So if you're living by yourself before tax, your income from the pension is $25,500 per year. As a couple, that's $38,700 before tax. And again, remember that peak happiness income is $179K. So if you're by yourself, you're 7 times lower than that peak happiness income. If you're a couple, then you're 4.6 times lower, although you're a little bit unhappier because you're splitting it with someone else.
And I guess the key thing here is that, the pension's not there to make you happy in retirement necessarily.
It's there as a stipend. It's there to help you get through.
And it's quite interesting because even some people who are really clued up about finance and money still don't fully understand the pension. Now, just to throw her under the bus, I get a text from Ilsa Wolf, who's coming on the show very shortly, and who is running the Opus Active or Opus Accelerate service. That's the one where she helps and coaches people to renovate properties, run a burst strategy. And she said, look, well, has the pension been decreasing over time compared to inflation?
Which is an interesting question because my anecdotal answer was yes, it would.
But the answer is absolutely not, actually.
I hate when this happens, when Ed goes out and gets data to debunk my myths.
Well, and the reason behind that is that the level of pension is actually pegged at the moment towards the average wages. And so if the average wages go up, so does the pension at the same rate. So at the moment, I believe the pension is pegged roughly at about 66% of the average wage. And every year, the 1st of April, there is an adjustment made. First, it adjusts for inflation, and then there's an extra adjustment to bring it up to the level of that 66% of the average wage. Now, what usually happens is average wages, average incomes might go up by a rate of 3 to 4% every year. Sometimes it'll be bigger, sometimes it'll be smaller. Average prices or average inflation at the moment is about 1.5% to 2% per year. And so generally we would see the retirement income increasing at a rate that's actually faster than the rate of inflation. So what you can actually buy off the pension has been increasing over time. Now, of course, that's quite cold comfort still to anybody who's solely living off the pension, given that it is a relatively small amount, but it is increasing at a rate faster than inflation generally. Now, I don't expect that to stay forever, of course. I expect that they will kick it back to the rate of inflation, which was suggested at the last review of the retirement and superannuation scheme.
When was that?
It was only about last year.
Right. And how often do they do that? Do you know?
I think probably when it's needed.
Spoken like a true politician. So how do you create this income for life? So firstly, you need to build an asset base that you can generate your passive income from. And what I mean by that is you need to create enough wealth that you're not going to actually erode your capital. So if you're going to invest in shares and you're going to get a dividend payment of 5% a year on average, then you're going to need to have $3.6 million worth of shares. Property, we tend to work on a net 4% yield. So that would work out to be a $4.48 million investment, which is another $900,000. So it's more because it's a lesser percentage, or what we base it on. If you're hoping to have that money in a nice, safe term deposit, and we've used the average 12-month fixed term rate with the banks at the moment of 0.8, then you just need a modest $22 million. So another $18.8 million than the shares. So it's no surprise that people are moving to more aggressive investments like property or shares now. People are looking to turn their term deposits into those kind of assets because it generates a far better return right now. And the key message here is that you do need to build up your asset base first, because every year that goes on, because of inflation, you need to create a bit more of that initial base. Because of course, if you look at, the $4.48 million worth of freehold property you need today, then in 20 years' time, you have to apply inflation to still be able to buy the same level of goods with that income.
And certainly 179K is a lot of money for a lot of people. And remember, for anybody, because a lot of people don't earn 180K per year. I think only about 2.4% of people actually earn that per year. Remember, this could be household income. So if you're 2 people earning 90K each, that's still the peak happiness income in that instance, because you within your family unit, your household unit, are earning that. So it is an achievable amount between a 2-income household. household. So I do just want to mention that 180K, that is a lot of money, and very few New Zealanders actually earn that personally, but you've got to look at it as a household as well. Now, let me ask you this though, Andrew. If you had 179K every year for life starting now, what would you do with it?
I'd keep working. For two reasons. Number one is I think my lifestyle probably requires me to keep on working for a little bit longer. And second of all, because I enjoy my job, I enjoy being here with you, Ed. But I do think that, there are people, myself included, that have quite high expectations of what they want for a passive income later on. So for me, got to keep working. So let's talk about how this has changed over time, because there was another really interesting article that I saw at the weekend, and they were talking about the fact that, term deposit rates have more than halved, and we need way more money in a term deposit to generate the amount of income that we're used to. And so they were showing this in US dollars, and we'll put the graph in the show notes for this one. They were showing the amount of a term deposit needed to generate a $40,000 a year pre-tax income. And it's amazing because you go from 2000 right the way to 2019, and there's a bit of a change, but not a drastic change. And then 19 to 20, there is this major spike. You go from sort of under $1 million back in 2000, and it is relatively flat. Then you get up to 2019, and you're about $1 million. Now 2020, you're $3.5 million to generate that $40,000 a year income. So people who were relying on their money in the bank to generate them a nice, safe return now are eroding that capital and are going to have less and less each year as a result of these really low interest rates.
Now, you might wonder, why do economists even bother trying to calculate peak happiness incomes? Why do we bother looking at this?
Because you've got nothing else to do at the weekends.
No. That's actually kind of true. Just because I love my spreadsheet. So I spent the whole weekend working on some amazing stuff, which I can't wait to talk about very shortly. But usually an economist would look at what income provides an amount of happiness, usually because it's an argument for higher taxes. And so people will say, or an economist might say, well, if people don't get happier after, say, their $200,000th dollar, if an extra dollar after that doesn't make them happier, then why don't we just tax that and give that to somebody who was on a lower wage? Because if it's not going to produce a higher level of well-being for that already affluent person, why don't we redistribute that in order to make the general population happier?
I tell you what, I'm quite hurt by that assumption, because every dollar that I pay to the IRD still hurts me just as much.
Well, actually, that's one of the interesting things, is that everybody's, if I can say this, utility curve or satisfaction curve for money is going to be different. So, of course, while some people might be extraordinarily happy once they make their $180,000th dollar, so once they get to 180K worth of income, there are going to be some people who are just hungry and hungrier for more money after that. So who's to say that the extra dollar that Jeff Bezos now earns after his 180 billionth might make him extraordinarily happy, because everybody's satisfaction for money or satisfaction in general is going to be different.
Do you imagine it does? Do you imagine Jeff Bezos walking through a cafe, sees the dollar on the ground and goes, I'm not going to miss that, bends over and picks it up?
I think he'd pick it up. I mean, it's for the good of society, really. Somebody might slip on it otherwise.
My money's on not.
Well, this always comes back to, as well, this theory of diminishing marginal utility. I think I've got time to talk about this.
You need to, because in reading my preparation notes for today's podcast, I saw Ed Morrow Bar in Year 11 Economics, and Ed is always just full of stories, so take it away.
Well, this one comes from, as I said, Year 11 economics class, and they start to, actually, I think it might have been Year 13 economics class. And what they do,
changing it on his paper now, even though we're finished, yeah?
Well, what we did as an experiment is 3 people would go up to the front of the class, and I think we had Morrow bars, Coke and bananas. And Vinda, Miss Taylor, got people up to the front of the class and says, okay, each one of you people have this. And they started you off. Cool. Have this first.
Did you go up?
Morrow bar. Yes, I think I was on the Coke, actually. Eat this Morrow bar. So you eat the Morrow bar. How happy are you with it? Okay, I'm a 10 out of 10 happy with this Morrow bar. God, that was wonderful.
Yeah.
Right. Next one, have another one. So then you eat the second Morrow bar.
Now you're saying a little bit.
But sick.
Yeah.
8 out of 10, I'm happy with that Morrow bar. Yeah, have another one. 6 out of 10. Have another one. 4 out of 10.
Is this how you became a vegan, being force-fed Moro bars in economics?
Well, the idea behind this is as you have more and more of a particular good, whether it be Moro bars or Coke or bananas in that case, you get less and less happy. Each additional one you have makes you less and less happy.
See, this is an interesting theory, but last night while we were watching a movie, I'm pretty sure I saw Lauren consume 20 Moro bars out of the favourites thing. She didn't seem any less happy by the end of it.
Well, they're smaller. That's the issue with it. But the whole point about this is how do you then apply that to money? So the idea that sometimes happens is that if you have more and more money, that extra dollar makes you, still will make you happier, but the amount of additional happiness you get out of it declines over time. That's really what we're talking about here. And the question is, at what point are you the most happy? Has that income really satiated you in that instance? And that's why economists love to try and figure this out and apply some of these quite simple concepts to something more complex like money in that instance.
I also think a very weird third option was bananas.
Oh, I suppose she was trying to just use a different good. Now, I'll tell you a wee story, and I think we'll cut this out for the podcast, but for anybody watching the video, we'll leave this in because you guys will enjoy this. There was actually another economics teacher who was at school at the time, and I love that now that I'm just talking to the people who bother to watch the YouTube versions of this, we don't have the same time constraint, so I can kind of rattle this off. And so we had a visiting teacher who was from Kings, and he said, Mr. Goldie was his name. And it was
Great last name.
Yeah. And he said, when I used to teach this at Kings, after each one we'd do it with pies. And after each pie, you had to go for a run around the field.
Oh,
so
and what, did someone end up throwing up?
Yeah, that was the idea. Oh. He said it was great fun.
So this was just to speed on the effects of the dissatisfaction of the pie.
That's exactly right. So you ate the pie. Oh, that's a 10 out of 10. Right, go for your run around the field. Have another one. Go for a run around the field.
So perhaps at our next live event, we'll have a bunch of pies and cakes for everyone to eat.
We could do economics tests.
I don't know about this, mate.
I think that'd be quite good. Anyway, let's wrap it up there. But please don't forget to rate, review, and subscribe to the podcast. Really does help us get the message out to more people. And hey, if you'd like to meet Andrew and I in person, we are running these property investment dinners. We're coming to Christchurch, Auckland, Wellington and Queenstown, and we are going to pay for your wine as long as it's house, and we are going to pay for your dinner. Now, how do you enter the draw in order to come along to that? Follow us on Instagram. We are at @opus_partners. Share us to your story or feed, and please leave us that review on your favourite podcast listening app. Screenshot that, send it to podcast@opuspartners.co.nz. We'll put you in the draw.
I'm not drinking house wine, just so we're clear.
Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And we're going to be back again tomorrow with even more daily strategies, tactics and insights to help you get the most out of the New Zealand property market. Until next time.